Okay, we're on the final stages here of chapter 10. Okay, so we've covered the calculation of a bond issued at a discount. Let's look at the journal entries here. Okay, here's what's going to happen. We're going to have cash, and normally at par value, this would be $100,000 credit to bonds payable, and we would have an equivalent $100,000 debit to cash, but that's not the case here. We only accepted $92,278, a huge discount of the actual face value of the bond. And so we have another debit we have to make to ensure that debits equal total credits. So do the math here and you find out that you need a debit of 7722, and that will bring this up to 100,000. This category here, this account, is called discount on bonds payable. And this is an equity account that is contra. Okay, so equity normally goes up with a credit. Therefore, this goes down with a debit. And obviously, if equity going up is a good thing, you want more equity, not less, then this is a bad thing. Okay, we are typically taking this discount, but we have to do it because our rates were lower than what the market would bear. Therefore, we had to sell the bond at a discount. Okay, so here's your accounts right there. There's your journal entry for a bond issued at a discount. All right. The journal entry for the payments, okay, every 6 months, going to say bond interest expense 4,000, and you're going to pay out cash of 4,000. Okay, this doesn't include any accruals, but clearly, if you had an accrual halfway through this 6-month period, you would have to account for that with interest payable and recognize the expense in the period in which it occurred. Okay, here's the simplest case to do it. At maturity, we would still pay out bonds payable of $100,000, and we would pay out the full $100,000 in cash, even though they only paid us $92,278 in cash. Okay, so understand that you still pay out the full bond, full face value of the bond. Okay, the other option, opposite of a discount, is bonds issued at a premium. Suppose we're Reebok Incorporated here. We want to issue a $40,000 bond at 12%. It's an 8-year term. Excuse me, the market rate is 10%. Suppose then that we've got to figure out, wow, is this a discount or a premium? We're offering 12, the market's dropped to 10%. Nobody's going to go to the market at 10% if they trust us and they like our company and they think we're solvent and reliable and they can get 12% from us. Well, this is a better financial investment for investors. Therefore, they're going to come to us, so we should charge more. That's called the premium. Okay, if we have more value, then we should charge more. Okay, find the issue price, show the journal entries at issue, show the interest payments, and at maturity. Okay, what I want you to do right now is we're going to pause this thing. I want you to actually pause the movie, and you go try to solve this following what you just followed here with the discount. Okay, it's good practice for you. So actually, I want you to pause the film. I'm going to pause here for a couple seconds. You hit the pause button and go try to solve it, and we'll go over the sample on your own. Okay? Okay, we're back. All right, so if you were to find the interest payments here, you would actually find $40,000 times 12%. Remember, we do use the coupon rate, the contract rate, the rate it says on the bond, and you'd multiply that times half a year, get $2,400 every 6 months. All right, then we find the issue price of the bond by calculating net present value using the market rate, which is 10%. Okay, so now that we've got $2,400 every 6 months, we would just simply set up the present value of the annuity equals $2,400, that's the amount of each payment, times at 8 years, that means n equals 16. Remember, we double that, it's a 6-month period. If the market rate was 10%, we don't use the 12 here, we use the 10, the market rate, but that's every year, so 5% per 6 months. You go n equals 16, I equals 5. I doubled the term, I cut the interest rate in half. I go to the table for the annuity, B3, and I pull 10.8377 times 2,400, I get $26,011. Do the same thing for the principal. I go to a different table, same factors here, n equals 16, I equals 5. Again, we doubled the term because it's compounded twice a year, semi-annually, and the 10% gets cut to a 5% every 6 months. I go to the table B1, I get 0.45811 times 40K, I get 18,000. Add them up, I get 44,335. What was the face value? It was 40. So this is a decent premium, about 4%. Okay, so 44,335 is greater than the face value of the principal, and what would the journal entries look like? Just like last time, I would actually collect more cash this time, 44,335. The bonds payable is what it is, just what it says on the paper, 40,000. And notice the discount on bond premium, I'm sorry, discount on bond payable last time was a credit. I'm sorry, it was a debit. Now it shifts to a credit. Owner's equity and retained earnings accounts go up with a credit. Therefore, you get this one as a credit. So this is good for owner's equity. All right, interest expense 2,400, cash 2,400 is a credit, and at the end of the bond, you have bond payable. You pay down the liability, goes up with a, or I'm sorry, goes down with a debit. Cash goes down with this $40,000 payment. And there you go. That's bonds issued at a premium. Okay, there's a couple other things about bonds we're going to talk about, and you might recognize this character over here. It's David Bowie, and he actually was a very, very original financial pioneer in that he wanted to even out the payments from his royalties. So in the early 90s, okay, David Bowie took out a possibility to fund bonds for a 10-year period of his royalties. He said, well, let's just take money now and you can have the rights to all those royalties. So this, I'm not sure, a banker named David Pullman did this. You can read this article. Basically, Prudential Insurance Company bought them all. And when you think about this, that this was a very, very shrewd move. I don't know if he got lucky. I don't know if he foresaw the future, but in the early 90s when he did this, David Bowie locked in payments back before Napster, back before the internet, back before LimeWire, and all these file sharing websites like Pirate Bay and everything. So he actually locked in royalties when there was actually quite a bit of money to be made in royalties, and that market has since evaporated quite a bit. Artists don't make nearly as much money selling CDs and vinyl albums like they once did. So Bowie really lucked out here, or he was a brilliant foreseer of the future. In fact, this guy says, is David Bowie to blame for the credit crunch? So he's arguing here that when David Bowie in 97, he took in a lot of money and issued paper, which guaranteed somebody else would collect his royalties, but the royalties went down dramatically post Napster, if anyone remembers that. So anyway, take a look at David Bowie and Bowie bonds. There is an article posted online on Blackboard. You'll see Bowie bonds. It should be coming up under the chapter modules. The other thing you should check in chapter 10 is there is a full solution. It's a big file. It is over 100 megs, so let it load if you have to for a long time, or you can go to the YouTube site and see that. Okay, but that's basically how bonds work, and you'll need to understand bonds inside and out, both the journal entries and the premiums and the discounts, and so be ready for it. Chapter 10 test, I think, is coming up in week 12, the week of November 5th, so be ready.